Hello students, I'm Dr. Anita Pandey from Sri Shankaracharya Mahavidyalaya Junwani Bhilai, and today I'm going to tell you all about liberalization. So first let us look at what exactly is liberalization. So liberalization is an economic philosophy, an entire change in the attitude of a government of a particular country. Liberalization is also the precondition for privatization and globalization. Precondition means certain conditions which should exist before happening of a particular event. So for happening of privatization and globalization, which we have already understood in previous lectures, liberalization should have already occurred. Liberalization is a broad term that usually refers to fewer government regulations and restrictions mainly on economic activities. Now, see, every country has a particular set of rules, regulations, trade, taxes, etc., which regulate the trade in that particular country, be it of that domestic country, be it of the domestic industry, or be it of the foreign investors or businessmen which come to that country for doing business. Now, liberalization is all about lowering those barriers to trade, those obstacles to trade, which make it difficult to establish business, particularly by foreign nationals. So, this liberalization is basically a change in economic philosophy of a state. Most high income countries have pursued the path of economic liberalization in recent decades with stated goals of maintaining or increasing their competitiveness as business environment. Now, see here, why liberalization increases the competitiveness? It is because when suppose a country is there and the government of that country is very protective about its domestic industry, and they have erected so much barriers to trade that it is very difficult for a foreign national to come and do business in that country. Now what will happen? There will come a point of time when there will be stagnancy in the market of that country and industries of that country, because the industrialists, the manufacturers, the traders of that country will become totally complacent or totally satisfied that yes, there is no competition from foreign nationals or foreign country, and we are the entire market is ours. So they won't put in effort for no introducing or launching more products. What I mean to say is they won't put in that much of effort in launching new product, because mostly see like in our country most of the technology is a Japanese oriented. So imagine a scenario where the government of India erects so much trade barriers or makes trading or business of foreign nationals so difficult that they are not able to come to India and do business, and because of that we are unable to get any foreign technology, or we are not able to get finer or more efficient products. So of course the entire industry of our country, domestic industry, will become totally complacent that the entire market is theirs. So we won't get that much variation, so that much differentiate different types of products or that quality of products, and gradually over a period of time competitiveness will reduce, thus reducing efficiency and effectiveness of the entire market. So liberalization as a process is very important as far as the balance is maintained. Sorry. Now let us look at features of liberalization. Now core features of liberalization are as follows. That is a change in the attitude of state towards an industrial society. Now the attitude of state, by state here it is meant a nation, a country. So liberalization is all about the change in the entire attitude of a nation regarding and moving towards an industrial society where more and more players are allowed entrance in that society, and they are able to bring in their own product, their expertise, their core competencies, thus making the market more and more efficient and introducing more products, more technologies, and enabling innovation. A change from a centrally planned economy to a market-led economy, market-led country, right? So what do you mean by centrally planned economy? Centrally planned economy is all about that the people, the bureaucrats or the politicians that who are sitting at the top, they are planning the economy, they are running the economy. It is more or less like a communist economy, which is what happens when the government has total control over the market. The government is influencing price, the government is influencing the kind of product that is available in the market, etc. To market led economy. of a country. So, what do you mean by market-led economy? Is that market-led economy is the forces of market, demand, supply, and no demographics. See, demographics in the sense the what are the main constituents of the population of a country. Like if there are more youth in a country, in the population of a country, like that of in India, then more youth-oriented products, say like iPods, mobile phone, smartphones, then no earphones, jeans, t-shirt, the swanky kind of t-shirts, jeans, etc. They will be more in demand, more you, and whereas on the other hand, if the major constituent of a country's population are older people, then what will be demanded is like things like walking stick, medicines, no, those kind of things. A change from excessive government intervention to minimal intervention, which is all about liberalization, that is reducing trade barriers, and a change from nationalization to privatization. Nationalization is all about establishing more and more public sector units, etc., which are more or less government controlled, to moving towards privatization. Now, let us understand economic liberalization. Economic liberalization is the lessening of government regulations and restrictions in an economy in exchange for greater participation by private entities. Now, when government reduces its various regulations, restrictions, etc., only then the private sector is encouraged to participate more in the economy, which is what happened in the 1991, in the year 1991, when our economy underwent a huge change and we adopted liberalization, reducing all the trade barriers. Thus, liberalization in short is the removal of control in order to encourage economic development. Now, if suppose there is an industry where the rules and restrictions are quite strict, you have to get a lot of license to establish business there, then automatically people or the businessmen will move away from those type of industry, will get totally repulsed by those industries, because nobody wants to get into that much of bureaucratic process or red tapeism, right? Liberalization policies includes partial or full privatization of government institutions and assets, greater labor market flexibility, lower tax rates for business, less restrictions on both domestic and foreign capital, open markets, etc. Now, liberalization is all about this partial or full privatization of government institutions, assets. Now, there will be more greater market flexibility as far as labor are concerned. Then tax rates will get reduced, then, of course, and then there is lesser restrictions on foreign capital. Effects. Now let us look at the effects of liberalization. So effects of liberalizations are removing barriers to international investing. Now the economic liberalization process begins by relaxing the barriers to trade and investment and relinquishing some controls over the direction of the economy to the private sector. This often involves some sort of deregulation and privatization of companies, which also opens avenues of international investment. The government, if you read recent developments, the government has been making more and more efforts to attract foreign direct investment from abroad. If you look at the recent release even by SEBI, then they have released external commercial borrowing norms, which are also facilitating towards attracting more foreign direct investment and easing that entire process of borrowing from foreign markets, or no getting borrowings in foreign denominated currencies. Now what is all this? It is all about removing those barriers which are preventing the inflow of international investment, because international investment will also enrich foreign exchequers, our foreign reserves, right? Then unrestricted flow of capital. The primary goals of economic liberalization are free flow of capital between nations and the efficient allocation of resources and competitive advantages. This is usually done by reducing protectionistic policies such as tariffs, trade laws, and other trade barriers. Now again, this is the same thing that we discussed earlier, that the liberalization is all about reducing that protective attitude of the government towards domestic industry or protecting their own boundaries as far as economy is concerned, and it is all about maintaining that balance which will enable free flow of capital between various countries, This will enrich the foreign exchequer balance. And then stock market performance. Now, as we learned in the earlier lecture in globalization, we discussed that any major event in the foreign countries have effect on the domestic markets also. So, sorry. In general, when a country becomes liberalized, stock market values also rises. Because why the stock market value rises? Because when a country becomes liberalized, more and more businesses or more and more businessmen come to that country to do business. This in turn raises stock market. This in turn introduces more capital, more cash into the market, into the circulation of cash flow that happens in the market. Fund managers and investors are always on the lookout of new opportunities for profit, because of course they're all always about looking out for more avenues of investment. So they will invest their money or the money of their clients, so they are looking at new and more opportunities. The situation is similar in nature for to the anticipation and flow of money into an initial public offer. Now, political risk also gets reduced due to liberalization, because for the government to continue to attract more foreign investment, areas beyond the ones mentioned earlier have to be strengthened as well. These are areas that support and foster a willingness to do business in the country, such as strong legal foundation to settle disputes, fair and enforceable contract laws, property laws, and others that allow businesses and investors to operate with confidence. Now, these laws, if there are better foreclosure laws, strong legal laws, contract laws, and better enforceability and implementation of those laws, then that attracts the investors and businessmen from foreign countries and reduces political risks. Now, another effect of liberalization is diversification for investors. Investors can benefit by being able to invest a portion of their portfolio into a diversifying asset class. In general, the correlation between developed countries such as United States and underdeveloped or emerging countries is relatively low. Now, what do you mean by correlation? Correlation is the degree to which two different variables move in a different direction. So, what is meant here is that investors can benefit by being able to invest a portion of their portfolio into diversifying asset class, which means that liberalization enables more business. Suppose Apple is a country of United States, right? So if it comes to liberalization has happened in India back in 1991, and now when Apple comes to India and invests or establishes its business in India and enters the stock market, then the people of India the investors in India will get to invest their money in Apple, the stocks of Apple, right? So what happens here is the investors get to enjoy investment in diversified asset classes. In general, the correlation between developed countries such as United States and underdeveloped or emerging countries is relatively low. Now, United States is a very developed country, and just as I explained, that correlation is the degree to which two variables move in the same direction. So the correlation between developed countries like United States and developing countries or underdeveloped countries is relatively low, because the underdeveloped country or emerging countries are not able to compete with that level of advancement or growth of as our developed nation have already achieved. So, although the overall risk of the emerging country by itself may be higher than average, adding a low correlation asset to your portfolio can reduce your portfolio's overall risk profile. Now, when you have a portfolio of investment, what you do is, if you are, of course, more risk gets you more reward, but according to your risk appetite, you also ensure an influx of lower risk assets or investments in your portfolio to counter those high risk investments, right? So that is what is explained here. Okay, although the overall risk of emerging countries by itself may be very high than average, adding a low correlation asset to your portfolio can reduce your portfolio's overall risk profile, which is what happens with the assets or investments of a developed nation. So you get that way, you get diversification in your portfolio. However, a distinction should be made that although the correlation may be low when a country becomes liberalized, the correlation may actually rise over time. Of course, market forces cannot be influenced by anyone, so there are also chances that that correlation may also rise in the future. A high degree of integration can also lead to increased contagion risk, which is the risk that that crisis occurring in different countries cause crisis in the domestic country. Now, contagion risk has contagion. The word contagion has come from the word contagious, and it means that if there is a crisis occurring in a different country, in some other country, then there are high chances that a crisis will also occur in the domestic country. The prime example of this was the Great Economic Depression of 2008, right? That entire depression, that entire that economic slump started from USA, and gradually it took the whole world in its fold. So what was that? That is every time that there is a contagion risk. Now let us look at risks of liberalization. Now, just as contagion risk, the other potential risks are risk of financial sector instability resulting from global contagion. Again, this word contagion. Um, Again, that 2008 crisis, economic crisis or economic slump, is the example here. Risk of brain drain. Now, what do you mean by brain drain? Drain is what happens when there is lesser or unsatisfactory economic opportunities for job, etc., in a person's own country. So what they do, they migrate to other countries in search of job or better job opportunities, better income, etc., and that way more and more intelligent people or intellectual people get drained from the economy, from a country. So that is what is brain drain. Risk of environmental degradation. Liberalization has opened newer avenues for businesses, which has increased the pace of industrialization, and industrialization again, or manufacturing process and everything again, leads to environmental degradation in the form of pollution or deforestation. Then there is risk of debt spiral due to increased tax revenue, among other economic problems. Now, debt spiral, because there are more and more paths or more opportunities to raise capital or take debt from other countries, or then there is decreased tax revenue, among other economic problems. There are emerging economic problems due to liberalization, due to maybe this global contagion, etc. And this has reduced our taxable revenue, and this has also debt spiral, because uh, the debt is also increasing because people are requiring or businesses are requiring more and more capital. So this is also a risk of liberalization. And then last is risk of increased inequality across races, ethnicity, or gender lines. For example, according to anthropologist Lilu Abu Loghor, we see increased gender inequality in new markets as women use labor opportunities that existed prior to market liberalization. Now, gender inequality is a rather hot topic in nowadays. So as it is, gender inequality has led to lower income. For we see that women are paid less for the same job and men are paid more, right? So that is what happens, and this liberalization has increased. There is discrimination due to ethnicity and gender lines across races, etc. Sorry. And this has increased inequality in the market. So this was all about risk of liberalization, and this is all about liberalization, um, and it here we end the topic. So thank you.